There are two concepts that we need to specifically talk about, which are very important in the housing finance sector. One, mortgage guarantee. What happens is there are risks involved with taking a loan. A risk that something could happen to your life or the bread earning member of the family. The second risk is something happens to the property itself, a fire, an earthquake, or any such natural or man-made calamity. And the third risk is the risk that the loan has still to be repaid. Against life, what would you do? You would take a life insurance policy. It's probably the oldest and the easiest way to insure the life of an individual. The amount of policy you take, the term of policy, the kind of policy entirely depends upon your financial planning and your financial planner. However, what is important is to know that if you as a lender are the main person servicing the loan and something happens to you, and it is important that we recognize that, then your family is not burdened with a loan which they cannot service anymore. The second insurance, as I told you about, is the insurance on the property. Properties are suspect to fires, earthquakes, floods, and any other natural calamity. It is important that your property is protected, and many people take and many lenders insist on what is called a property insurance. The idea is that if something happens to the property and it is compromised, the money from that insurance will pay for either reconstructing or repaying the loan or whatever else that you need to do given what has happened. The concept that I want to talk to you about really is mortgage insurance. So what happens is that in India we do have a company that actually does mortgage insurance. It's called the India Mortgage Guarantee Corporation. In mortgage insurance, the company works with the lender to whom you are applying for a loan, reviews its credit policies and says that you give this person a loan, and for a premium, we will guarantee a portion of the loan in case the recovery is not possible. It also says that if you were to give this person 70%, with a mortgage guarantee, you can even give 80% because 10% is guaranteed against default. Of course, there is a cost to it. There is a premium that has to be paid like any other insurance. Some lenders bear that cost. Some lenders pass it on to the individual to pay. The individual then, like you and I, have a choice. 80% with the premium to be paid or 70% without the premium. So it works in different ways for different lenders, but the concept of mortgage guarantee is slowly but surely picking up in India. We have one company that provides it today, and I'm sure going forward you will see more. As a lender, it is important that you understand the value that the mortgage guarantee brings. It gives you the comfort that you know that a portion of your loan is insured against default. As a borrower, the advantage to you is that you get a higher loan. That 10% from 70 to 80% is being given by a lender because there is an insurance. If there is a cost, you have to weigh the costs versus the benefit. And the way to weigh it is that if you have to pay an extra amount of premium, is it going to be beneficial for you to take that extra amount of premium and then know that you have the comfort that 10% of your loan is guaranteed against delinquency. Now, another important component we should understand here is the risk weightage that the regulators expect you to provide for every time you take a loan. The regulator defines the weightage on a housing loan, on a secured loan compared to, say, for example, a personal loan. And that is what your accounts and your finance team has to provide for in the books of accounts. Risk weightage changes. It depends upon the loan amount, it depends upon the security, and it is different for housing loans compared to, say, unsecured loans. The higher the risk weightage is, the more you will have to provide for. Again, as an example, sometimes the risk weightage could be 50%, it could be 30%, it could be 80%. And the reason I'm giving you this range is because it changes. Recently, in 2020, the Reserve Bank of India changed the risk weightage to encourage more lending to happen. What did they do? they reduced the risk weightage. And because of that, banks were encouraged to give loans and to give potentially a little more higher loan than what they would have otherwise given, and had to provide a higher amount. These are fiscal policy changes which the Reserve Bank of India uses to change the demand-supply dynamics of housing loans in the country.